More than 95% of retail forex traders lose money, yet banks are making billions of dollars every single day. So how do they do that? Well, in this video, we'll be giving you a strategy of how to trade like a bank, so you can profit with a high accuracy just like they do. The most common strategy bank traders use, and the one we'll be covering in this video, is based on fundamental analysis, and that's because bank traders have a huge knowledge about it. They use daily, weekly, and monthly charts because they understand the influence economic reports will have on the market over a larger period of time. The Forex bank trading strategy can be broken down into 3 steps: accumulation, manipulation, and distribution. But before we rush into the strategy, let's take a step back to understand that in every transaction that happens in the market, there are 2 primary participants, a buyer and a seller. And so what this means is that when you're trying to buy something from the market, there must be someone trying to sell it to you. And so when you're trying to sell something, there has to be someone willing to buy it from you. So when smart money, which is defined as large market participants, such as large banks, hedge funds, or whatever, when they are looking to buy their large position size in the market, there has to be an equal amount of selling pressure. And if there's not, the price will rise rapidly, revealing their position. And this is not what they want to do, so they keep it hidden. And how do they do this? By entering over a large period of time, leading us to the first step in the process: their accumulation of a position. Accumulation plays a vital role in the bank trading strategy. But what is accumulation? Well, it's an area where smart money accumulates their desired position. And as they have massive volume that they control, they have to enter their positions over a large period of time. And so this would occur when there's range bound or sideways price action. It's important to note that the primary function of these large banks is to make the market, act as market makers. And so they make money by accumulating a long position here, then later selling off up here, or accumulating a short position here, then buying it back at a lower price. So how you can trade like a bank is if you can track and find out areas where, when, and how the smart money is entering. You can identify when to enter, like these areas here, and the direction where the market will most probably move in the upcoming future. And so if you have an accurate idea where the market will be moving next, you're much more likely to be profitable. The next step is market manipulation, also referred to as the trapping zone, searching for liquidity, and the stop hunt. This is very easy to identify. It occurred here and occurred here. But what does this mean? Well, let's say you're here. Accumulation has occurring. You've identified that this is an accumulation area. So now what you need to do is you need to identify where the price will move to. So this is where you use your manipulation knowledge. Price is pushed higher than the highest point reached in the accumulation period. And so what this represents is a false push up. So now you would know that smart money have been selling. So when it closes back and comes back down, you would enter a sell. As you can see, price subsequently goes down. So let's find a bullish example. You identify the accumulation period, and so now what you need to know is where the price is going to go. You see here, there's a false push below the lowest point reached in the accumulation period. It closes back in the area, the accumulation area, and so you'll now enter a buy. As you can see, subsequently the price went up. The next step and the final step is called distribution, sometimes called the market trend step. You have identified the accumulation area here, and I've identified which direction they manipulated the market. They have forcibly pushed the price higher, so now you know that the price will come down. And so you have entered after this manipulation move or force push is clearly visible. You have entered a sell, and as price comes down, you go further and further into profits. You have successfully avoided the trap of chasing the false break as most retail traders do. And hopefully this will help you become part of the less than 5% of retail forex traders that are successful. Most indicators are reactive, and a lot of traders know this. Smart money use indicators to convince you to buy. So in the manipulation step, it sends you out a buy signal, when in reality this is just from a false push, pushing the price higher before it eventually comes down to the actual trend. Thank you for watching. I hope you enjoyed the video, and if there's just one thing you'll take away from this video, let it be this: you must have an informed understanding of how the smart money trade, and this will allow you to trade alongside them, allowing you to become a great success in trading forex. Don't forget to like and subscribe, and never ever argue with your trading system.